All right, we're back for another episode of The Mortgage Show. November 1st. A lot of stuff's been going on. It's election day. Beds, how are you doing?
Beds is good. I think it's actually November 4th, Randy.
It is November 4th. So here we are, dude. Yeah, time flies by. I don't know the dates, but here we are. It is November 4th. So
So we have a lot of stuff to discuss. What are you thinking so far?
we do have a lot of stuff to discuss, dude. It's been a busy week in mortgaging. We can just start with the thing that most people ask about or talk about or post about online, and that's just about the Federal Reserve meeting last week, what happened, some of the comments after, how the market has reacted, what our thoughts are on it, and then just kind of go from there. So do you want to give a little bit of a highlight about what happened last week?
Yeah, so we had a quarter rate cut in the Fed's fund rate. Out of everything that we saw in that report, it's clear as day that like the economy is stagnating a little bit, so the cost of borrowing needs to go down. The Fed fund rate goes down. And then, the initial knee-jerk reaction of the mortgage-backed securities is that it actually goes the opposite way for a short period of time, and then the mortgage rates start settling down with that the Fed reduction.
Can we talk about something real quick?
Yeah, go ahead.
We talk about this every month, but mortgage rates do not react directly to the Federal Reserve cutting the Fed funds rate. They are market driven, trading mortgage-backed securities. So the market had already anticipated a rate cut last Wednesday. Some could say that the market anticipated even bigger rate cut than what we ultimately got, but at the very least, the 25 basis points, which is what was cut. But the thing that has driven rates in the opposite direction since then is Jerome Powell's comments after that meeting,
Yeah.
calling out that inflation is still a concern, a rate cut at the next meeting is not a sure thing, and the next thing you know, the market reacts like it has been, and rates have gone up to what I believe is the highest they've been in over 3 weeks. So,
And I think some of the stuff that drives Powell's thoughts with that is all you ever hear is just the negotiation with tariffs and how inflation is coming. Inflation is coming because of that. I've been paying attention to it. I haven't seen it yet. I'm just kind of curious if it is going to hit us. And I think that's why Powell brings it up. As a reminder, inflation is very bad for mortgage-backed securities, which means they are very bad for mortgage interest rates. They go up. I don't know, Randy, TBD with that. I haven't seen it yet. So he's smarter than I am, right?
yeah, I
So
mean, they all are. It seems to be they're hesitant to move too fast. And I don't know if it's politics or what the reasoning is for all of that stuff, but the Federal Reserve and Jerome Powell in particular just doesn't seem too quick, or they don't want to be too quick to cut rates or more than they should and get us into a kind of a mess that we had a few years ago where inflation spikes, rates spike from 22 to earlier this year. I mean, there was a higher rate environment. So it just seems like they're not in a rush to get back there and they're kind of taking it slow. So,
the Fed is independent of everything, right? So allegedly politics do not play into this. It was just interesting the last year of Trump's first term, I sort of expected them to jack the prime rate because I don't know, it was obvious to me that we were heading to such a heated up area, but they didn't do anything. So, and then, the last couple of years of Biden, I thought they would have reacted a little quicker on the opposite side of things, but it didn't happen. So is it politics? I don't know. I don't know. It's been interesting navigating this for sure. I did want to touch on something you said as far as like the Fed's fund rate. Just a reminder. Randy just said it, but I'm going to sort of say it in a different way. If Randy is a bank and Chris Bedard's a bank, the Fed funds rate is the suggestive rate that the Fed says to Bank of Randy, Bank of Chris, here is the interest rate that you should be selling to consumers. So then it's up to Chris and Randy's bank to decide what margin we add to it that we turn around and offer to consumers. So that affects credit card interest rates, car loans, personal credit lines, and it actually is tied to home equity line of credit. So,
yeah, dude, it is amazing how many people think that the mortgage rates are connected to the federal funds rate in a direct way, meaning like on Tuesday last week, rates are going to be one thing, and then after Wednesday, after they cut rates by a quarter point or 25 basis points, rates will then drop by 25 basis points, and it's just not the way that it works. We'll keep having this conversation for the rest of our mortgage careers, but it just is what it is. And it's worth spending a second to go over it now.
So, and you did mention, interest rates were up a little bit after this meeting. Powell did say something about, the presence of inflation moving forward. And what we're going to end up seeing now is, as day goes by and week goes by since Powell said that, we'll see economic data come out that's stale and mortgage interest rates will settle back down. So it's this constant seesaw that we deal with.
Yeah. One thing that's worth mentioning is generally what interest rates are right now. And when I say general, I mean like not being very specific at all, but just to give you some ranges, because people ask all the time. I don't know if they ask you still, but like, what's the 30-year fix at? And there's a million asterisks that go along with answering that question. But like in general, 30-year fix with good credit, conventional loan is in the lower threes, right? Like, I mean, not lower threes, lower sixes. I get my dates wrong, my percentages wrong, but yeah, in the low sixes, whether that's 6 1/8, 6 1/4, 6 3/8, something like that. And it could be higher if your credit is a little bit more challenging. It could be even lower if you're doing a government loan like Maine State Housing, FHA, VA. So that's generally what we're seeing. Would you agree?
Well, let's piggyback what you said. It's funny that you said low threes. It's common in our industry for consumers to see interest rates that are consistently lower than what Chris and Randy would say a rate is. Our former business partner, Brian at Bangor, we could throw out a bunch of names of our competitors and people that we like around here. But here's the thing I guess here's where I'm going with that. You're going to see marketed interest rates all the time. The thing to pay attention to is the APR attached to it. You're never going to see a market rate advertised without cost because it's not the shiny toy that you are looking to buy. You know what I mean? It's not the thing that you're attracted to. You want to see the lower interest rate, and all of these advertisements are of lower interest rates. Let's use your mistake of 3%. Yeah, you can see 3% anywhere, but you're going to notice the APR is like 7.5, which tells you as a consumer, you are paying an obnoxious amount of money to get it.
A lot of fees. And Rocket Mortgage is the prime example of this, and I have no problem saying that because that's the one that I would see most often is when you get a loan estimate from Rocket Mortgage with a nice low rate on it, borrowers don't fully understand that they're paying a significant amount of points for that rate. And it's oftentimes not worth it. Dude, I've been pricing out points for my whole career, man, and it just seems like over the past couple of years in particular, if you're paying points right now, you're going to look to break even on those points in like 3 to 5 years.
Yeah.
40 something months. So then you really have a decision. Does it make sense to pay all of these fees up front for a low rate that you're going to break even on in 3 or 4 years? You're telling me you're not going to refinance in that period of time if rates go down? So, a lot of considerations, but please know that there's more to it than just throwing a rate out there. There's a lot of costs involved. You got to make sure that you're comparing apples to apples.
I think our national average is still under 4 years for a consumer to turn over their mortgage that's either divorce, that's refinance, or, downsizing or upsizing, if I'm saying that correctly. So it's like points never make sense.
Very rarely. Like maybe back in 2020, 2021, when you're like, well, this is ridiculously great interest rates, and I know I'm going to be there forever, so I might as well throw a little bit of extra money on it and make it a very, very low rate, a little bit lower. And, because I'm going to die in this house with this mortgage, maybe. But like in this environment where there's a fairly decent chance that rates go down, that like you'd be, in my opinion, wasting money. So anyways, but just know that if you're seeing, like you said, nice shiny new toy rate online, or your friends are talking about it, or colleagues are talking about it, just be curious about what goes into that rate. Are they paying a whole bunch of fees to get that? Because typically we start, at least when I quote rates, at the no point rate, meaning no additional fees besides closing costs. So we want to just make sure that we're comparing apples to apples, because the rate that I quote with no additional points is going to be higher than the rate that's quoted with a bunch of points. Obviously, those things are not going to be the same, but the other difference is the fact that they're paying a bunch of fees to get their rate, and they're not paying a bunch of fees to get our rate. So anyways, could go all day on that.
I think to scale it back, somebody says, hey, Chris, hey, Randy, what's the rate? It's kind of interesting what we have to go through to actually provide that answer. It's a loan to value thing. It's a mid FICO thing. If it's a single family home, if it's a condo, if it's a multifamily, if that multifamily is owner occupied or not, if it's conventional versus FHA. We are forced to be so vague in that moment to say an interest rate, because legit, We need to know what your scenario is. We need to know what your FICO score is, how much money you're going to put
Are
down.
we locking this rate for 30 days, 45 days, 60 days? Is it going to be a primary residence, second home, investment property? There's a million things. It's a whole computer screen worth of things that we have to fill in just to get a rate quote. Yeah, dude, I just don't think people realize that.
And I guess to have some fun with this, there's some nerds somewhere that are determining loan level pricing adjustments that determine what we're doing to give this very vague answer.
Yeah. Yeah. It's a lot of fun. Don't love getting the question, but it's a reality of our job, and it's something we have to be prepared to talk about. But this is just us digging a little bit deeper into that if you're listening. So anything else to put a bow on the
Yes.
Federal Reserve talk?
Not the Federal Reserve, but I just called them nerds. Can you call people nerds these days?
I don't think you can. You may be canceled. Sorry, dude.
Damn it. Damn it.
You'll have to do something else.
I'll be a hand model. No, I guess for the Fed, if you really do like this conversation and if you're curious about what's going on with the Fed, pay attention to the tariff stuff and if it creates inflation. I guess that's what I'm curious about.
That will be the thing that stops rates from going down as low as they want to go.
Yep.
So we will monitor. We'll keep sharing that info. I'm going to move on to the next thing. We're going through news and anything that kind of comes to mind, see how long this thing goes. But one thing that's small that's worth mentioning, conventional loan limit increase for 2026, $819,000 is the max conventional loan. I think it was $815 this year.
The NAR, I believe, is predicting 1 to 3% appreciation in home values the next 3 to 5 years. So it seems like we're going to have normal appreciation. I'm going to guess that this is the last time, Randy, for the next couple of years that the conforming loan limit goes up.
So what this is this is the max that you can get a conventional loan at. Anything above this loan amount will be what's considered a jumbo loan. It's just different type of financing with different terms and different rates and all that stuff. So the majority of the loans that we do are conventional loans that fall under that limit. But that's a high limit, and that reflects what purchase prices have done, or if prices in general have done over the years. Dude, I still think of the conventional loan limit as $417,000. So when I see 819, it's like, man, how much it's changed. I don't even know when 417 was, if that was the late teens. But that's the number that I recall the most when I think of conventional loan limit, and it's gone up a bunch over the years to what it is now at $819,000.
I'm Googling this right now, so keep talking.
Which part? The 417 or what, or like the history of what it's been?
Yeah, the 417. So let's see. AI is coming back. Whoa. 2006, Randy, it was 417.
But it must have stayed at 417 for like 10 years, because it felt like it was 417 for an extended period of time before it started going up a little bit. And what's that?
Dude, you really close, actually. In 2017, they raised it to 424,100. Yeah. So it's almost doubled in 8 years?
Yeah. And it was 417 for the longest time. So just shows you what's going on. And it's nice because a lot of people would go up to that max. For a lot of our career, 417 would end up being like the highest loan amount that we would end up doing.
Yeah.
Because of that conventional loan limit.
Yeah.
So anytime we got a loan over 417, that was like a big deal. We're like in jumbo territory. And now to think that it's 819, and I've done a decent amount of loans, that exceeded $417,000 at this point. I think my average loan amount is probably closer to 500. So it's just kind of funny how things have changed.
For me, I'm going to be curious to see if I'm right, if it's going to stay at 819 for a little while.
It can't go up every year, but honestly, nothing would surprise me. So want to share that. Anything else you want to say on that, Beds?
Maybe a little bit of something that we should talk about is 819 is on the conventional side. When you're offering an FHA loan as a loan officer, we need to pay attention to county loan limits, which are completely different than the conventional loan limit. So agents out there listening to us, there is a difference there. And FHA is typically quite a bit lower.
Yep. And then also, this is the lowest that it would be for conventional loans. There's other parts of the country that have higher conventional loan limits just because it's more expensive places to live. 819 is just like that baseline minimum. And then depending on which county you live in the United States, it could be higher than that. But for us, that's the big number that applies.
Random quick question for you. Do you get distracted when Macy is barking in the background?
I absolutely get distracted. And I'm just like, man, I hope you can't hear that. But yeah. And it's just because freaking leaf is blowing across the window and she's losing her freaking mind.
Dude, this new dog Tatum just sends me in a tailspin. She's an absolute lunatic. Barks at everything, eats everything, bites everything. It's nonstop chaos.
Yeah. Thankfully, we don't have the biting and the eating stuff, but the barking, dude, oh my God. When FedEx comes over, it's all, or UPS, it's all hell breaks loose.
So
anyway,
when they come over?
when they come over on the hour, you know, it's a nonstop.
All right. Sorry.
No worries, dude. All right. Want to talk about the next thing? Because it's a fairly big thing that's affecting the mortgage business or people are thinking about, but it's the government shutdown. Government shutdown's been going on for a month now, and people wonder how that affects mortgages. And in general, it doesn't have an effect. We're having a lot of business as usual, but does affect a few key situations. So I just want to run through some of those things.
Let's do it.
So I'm just going to read from a list. So furloughed or unpaid federal employees can still get mortgages just because they're going to get paid back eventually. We have to do verifications of employment a different way. The thing that's important to know now is that since we're past November 3rd, which is yesterday, today again is not November 1st, borrowers that are doing conventional loans do need to have 2 months worth of reserves if they are one of those furloughed or unpaid federal employees right now, which I don't have anyone in that situation. I don't know if you have anyone in this situation. So it hasn't affected my business directly, but that's how it would work in the event. I guess maybe shipyard people could potentially be furloughed or unpaid employees. We do a lot of shipyard loans, Portsmouth Naval Shipyard, but I've not experienced it myself.
Yeah, and I guess what Randy's saying is when we run desktop underwriting to let a borrower go out there to put offers in, is that desktop underwriting findings, if you will. I guess normally you'll see the borrowers not have to have reserves on most mortgage scenarios. Now the software reads, or I don't know if it's a software thing, Randy, or is it just an overlay thing where
I don't know if it's a manual thing or not.
It's probably a manual thing, but now we just basically
require reserves. Like reserves is not a thing unless you're buying multifamily property or you have other properties. If you're buying a primary residence, no reserves are required. So this is a unique change that we'll have to deal with for a little bit until it sorts itself out. But other than that, no big change.
So that just basically means if we have somebody that is about to sign up for a $4,000 payment, we need to have 2 months of that. Sort of in addition to the down payment and closing costs, we need to have $8,000 sitting aside now for that borrower's loan to go through.
So it's a little bit of a change. For some people, it might be the difference between them getting a mortgage or not. Hopefully, for many, though, it's just an added requirement. It's something they can still pull off. It's good to know that retirement assets can count as reserves. So that usually does the trick for a lot of different people if they have any level of retirement savings.
Yep. And I guess what this means is Fannie and Freddie Mac back our loans, and these are the overlords that say, hey, mortgage companies, this is what you have to do. So this is why this is here now. Fannie and Freddie are saying it.
This applies to all mortgages too. So it's not just Fannie Freddie's rules for CMG Home Loans. This is Fannie Freddie's rules for all residential lenders in the United States. So, all right, FHA, business as usual. I guess they're staffed down in the Department of Housing and Urban Development. But a lot of the stuff for FHA loans, assignment of case numbers, et cetera, is all automated. So that isn't affecting anything in this market. VA loans, same thing, no real impact. But where we're seeing the biggest impact is with rural development loans. Apparently 80% of the offices for RD, rural development, are furloughed right now. And of all the different types of government loans that we do, this is the one where we have to package up a loan at the end of the process, send it over to RD down in Washington, used to be up in Bangor, and they have to review it and issue a conditional approval prior to closing. So with them being furloughed, we're not able to get those conditional approvals, and we just can't close those while we're in the middle of the government shutdown.
Interesting loan, isn't it? So all of us mortgage companies, we underwrite these RD loans to RD standards, and as long as our underwriter has done a bang-up job, when it goes to Washington at the end, the final guarantee should be more of a formality. But it's an anxiety point, actually, if you're doing these loans, because, did underwriting do their job? Does that underwriter in Washington disagree with something that we underwrote? So yeah, with them unavailable, it's a loan that is affected.
Yeah, and this is for the main state housing variation of this as well. And I have a borrower that is supposed to close on December 15th, Main State Housing RD. And we've had the conversation about like, we'll be good except for whatever's happening with this government shutdown. If this is something that lingers, God forbid, up until then, like we're going to have to wait until the shutdown is over before we can close. So just kind of keep that in mind if you're doing that type of loan. And we do a decent amount of them, so it's an issue.
It is an issue.
Besides that, I mean, those are the main things that I would want to mention. Those are the main types of loans that we do. So in general, to recap, no real big changes for anything except unless you're furloughed or unpaid for conventional loans, but still can work around it. And then RD loans are the big ones that we just got to sit tight on. And we will see what happens in the weeks and months to come. We'll definitely keep everyone posted.
Yeah, man. Hopefully this is just like another week or two.
I know. It's hard to say. Other thing that I'd want to mention is just don't sleep on 20-year fixed mortgages. Rates for 20-year fixed mortgages are a lot better than the 30-year. So we'd be happy to price those out for people that are thinking about refinancing or even buying and just jumping right into a 20-year loan, because with the rate savings, the payment's obviously going to be higher than what it would be for a 30-year loan, but it might not be something that's that bad. And if you can avoid 10 years worth of interest, it's pretty significant. So don't sleep on that.
I like that you bring that up. We were talking about the loan level pricing adjustments, so your FICO score, how much you're putting down. A factor in the pricing that makes it go better is the shorter terms. So 20 years, 15 years, 10 years. We do crooked numbers, so we could do a 19-year or 14-year. So yeah, if you could actually shrink that term, the terms or the interest rate gets better.
And on those crooked numbers, like you said, the pricing goes up to like the next highest multiple of 5. So if you're doing a 17-year loan, that gets priced as a 20 until you cross that 15 threshold. A 12 would be priced as a 15, 9 would be priced as a 10, something like that. But yeah, the shorter term, better the rate. It's something that I think is worth considering.
I like it.
So what else you got for me, Beds? Anything else to discuss, or is that it?
I think we're pretty close to wrapping it up, but I think there's one thing we need to discuss.
Okay. What are you thinking?
I need an appraisal of my pickleball game from you.
Your serve is looking very good today.
Thank you.
So,
Thank you.
huge.
It's
Your serve makes a big difference.
Oh my God. It's such a crazy fun game, by the way. And you're only going to get better until you kind of feel comfortable, and feeling comfortable is the amount of times that you play.
Totally.
Yeah.
It's a factor of that at this point. I mean, at some point there's a limit to how much anyone can really improve just with playing more, but like you're definitely in that sweet spot of the amount you play directly correlates to how much you improve. And yeah, you can definitely see it. I mean, I'll still smoke you 9 times out of 10, but
I just needed to bring it up because our listeners, all 7 of them, need to know that besides, trying to crush it in the mortgage industry, we are trying to stay healthy. And one way we're doing it is with pickleball. I was late to the game. Randy has been playing for a few years. Randy invites me a couple times last winter, and I'm like, man, this game's fun, but do I really like it? Now I'm super effing addicted.
Yeah, we play every Tuesday morning. So set aside some time to get out there. It's fun, dude. I'm glad you're liking it. So I already can't wait for next week. And I don't think I'll be able to play this weekend, but
yeah, that's right. You're going to be gone. Most of you that know us, it's typically me and Randy playing against Brian Daly and Jason Dupree, and Saco has sort of leveled the playing field. But we've had a little interruption to our series because Randy had a surgery. He had some like beard implant thing. I'm excited to play those guys again soon.
Be fun. That's good. So we'll keep you posted on our pickleball improvements and games on the next episode.
Yeah. Until the next episode.
All right, guys. Thank you for anyone that's listening. Let us know if you have any questions, anything we can do to help, whether it's you, clients that you're working with, anyone you know that needs a mortgage. We will be happy to help. So thanks again.
Yeah, thanks for listening.